The Trump administration's policy mix is back in the spotlight. The Great and Beautiful Act extends and expands tax cuts. Total tax reduction in 2026 is projected to be 40% higher than in 2025. But widening fiscal deficits and resurgent trade protectionism are putting a question mark over the long-term growth story for U.S. stocks. The impact of fiscal stimulus is hotly contested. According to Shenwan Hongyuan, the median GDP growth forecast for 2026 from 74 institutions stands at 2.1%. But estimates range from 0.8% all the way to 2.9%. Optimists say tax cuts will fuel consumption and growth. Pessimists counter that interest costs have already eaten up more than 60% of the tax cut benefits, and the marginal effect of fiscal stimulus is fading. Trade policy uncertainty has markets walking on thin ice. On February 9th, Trump told Fox Business he's sticking to his hardline Iran stance and hinted at reopening an auto tariff probe against Europe. Meanwhile, the EU passed a trade deal with a sunset clause. If the U.S. doesn't scrap steel tariffs by 2028, retaliatory duties on American goods will snap back. Geopolitical jitters lifted oil prices. Brent crude futures closed up 1.2% on February 10th, making energy names like ExxonMobil and Chevron rare bright spots. This has widened the fault lines inside U.S. equities. At the February 11th close, the Dow was up 5.2% year-to-date, the Nasdaq had eked out just 1.8%, and the small-cap Russell 2000 was actually down 2.3%. By sector, tech is caught between an AI capex frenzy and bubble fears. NVIDIA's market cap has topped $5 trillion, but Morgan Stanley warns that rising HBM4 costs could pressure its 2026 gross margins. Consumer stocks are cutting guidance as default rates among lower-income households climb, dragging retailers like Walmart and Costco. Industrials such as Boeing and Caterpillar get a lift from higher defense spending, but rising supply chain costs are eating into their profits. The Trump administration's fiscal expansion plus trade contraction combo is rewriting the risk-reward profile of U.S. stocks. In the short term, the tax cut sugar rush and the AI investment cycle could keep indexes elevated. But long-term growth faces three hard ceilings. First, debt monetization risk. With national debt now over 100% of GDP, the Fed's independence is compromised, and dollar assets look less attractive. Second, global supply chain rewiring. Trade friction is accelerating friendshoring and bringing manufacturing back to the U.S. costs way more than expected. Third, tech containment blowback. Export controls on chips to China have already cost firms like Micron and Applied Materials more than $20 billion in lost revenue, forcing them to slash R&D. Investors should trim exposure to the Magnificent Seven tech giants and rotate into defensive sectors like energy and healthcare. Also, keep a close watch on the March vote on the U.S.-EU trade deal and April's debt ceiling talks in Congress. Both could spark volatility. On execution, stay flexible and avoid overconcentration in any one sector or industry. That's how you navigate the policy fog ahead.